You are in Athens, it is 2015, and the ATM tells you the limit is 60 euros a day, same currency as Berlin, but the cash in your hand suddenly comes with rules written somewhere else. So here is the question that makes the euro era snap into focus. How did a currency sold as stability end up turning a downturn in Southern Europe into a crisis where cash jobs and national policy choices started to feel constrained by outside forces? Here is the quick payoff so you are never lost. Europe built one currency, but it did not fully build the shared shock absorbers that make one currency easy to survive when panic hits, and in that gap, the South learned what no escape hatch really means. First comes the promise. Go back to the late 1990s. The euro launches in 1999 as a virtual currency, then becomes paper bills and coins in 2002, and the pitch was simple enough to feel inevitable: one money, one market, fewer barriers, more trust. For countries that had lived through devaluations and inflation scares, joining a hard currency club felt like graduating. Before the euro, currency risk sat behind everything. If you ran a business in Italy or Spain, you did not just plan around customers. You planned around the possibility that your currency could slide and your interest rates could jump. Investors demanded higher rates because they feared they would be repaid in money worth less. Governments paid more to borrow, companies paid more to borrow, and the whole system could turn tight in a hurry. But the old system also had one practical tool. If your country got too expensive compared to neighbors, you could devalue, exports and tourism got cheaper, and the economy could start earning again faster. The euro traded that pressure valve for credibility, and the immediate wow was that borrowing costs in the South dropped fast, because markets began treating euro members as much closer substitutes than before. Next comes the hidden mechanism. Interest rate convergence sounds technical, but it is really a belief shift. If lenders assume the risks are similar, they lend at similar rates. And once borrowing gets cheap, the economy receives a signal it cannot ignore. Cheap credit is not neutral. Cheap credit is a steering wheel. It nudges banks to lend more, nudges households into bigger mortgages, and nudges politicians to postpone reforms that would hurt today. In Spain, that steering wheel turned hard toward housing and construction. In Greece and Portugal, cheaper financing made it easier for governments to roll deficits and delay hard choices. In Italy, lower interest costs created breathing room, but weak productivity growth meant the underlying engine still was not accelerating. One quick grounding point so we do not turn this into a blame cartoon. The euro did not force anyone to inflate a bubble or run weak institutions, but it did make risk look cheaper than it really was, and that let imbalances grow larger before anyone felt the heat. And this is where the story takes a turn that surprises a lot of Americans. Germany's success inside the euro changed the outcome for everyone else. Now the imbalance. In a world of separate currencies, a country that becomes an export powerhouse often sees its currency rise over time, which makes its exports more expensive and naturally trims the surplus. Inside the euro, that pressure is weaker because there is no separate German currency that can rise on its own. The exchange rate reflects the average of the whole zone. Germany's economy, high productivity manufacturing, deep export networks, and years of wage restraint relative to productivity fit this setup unusually well. German firms could sell across Europe without the usual fear that a customer's currency would devalue and erase their price advantage. The result was persistent surpluses in the core and persistent deficits in parts of the South. And here is the one chart explains the decade moment with real numbers. Around 2007, Germany's current account surplus was roughly 7 to 8% of GDP. Spain's current account deficit was around 10%. Greece's deficit ran even larger, roughly 15% of GDP by 2008. If current account is not your language, translate it like this: it is the gap between what a country earns from the world and what it spends on the world. A big deficit means you need outside money coming in, year after year, to cover the difference. Here is the blunt "so what" that makes it real. That system works smoothly only as long as lenders keep refinancing you, and the day they stop, the adjustment does not arrive politely, it arrives all at once. Before the crash, Those capital flows looked like integration. Northern banks lent into the periphery. Money crossed borders with almost no friction. Everyone told themselves this was convergence. But the stability was conditional, and the condition was invisible in good times. Refinancing. Then the crash. In 2008, global credit tightens. Housing markets crack, growth slows, tax revenues fall, and markets do what they always do when fear hits. They stop treating similar assets as similar. Greece becomes the flashpoint, and by 2010, Greece enters its first bailout program. Here is the statistic that makes people sit up straight. Greek 10-year bond yields were around 4 to 5% in 2007, and in the crisis they exploded, peaking above 30% in 2012. That is not a normal repricing. That is the market saying, we do not believe you can borrow your way through this. If this is your kind of history where one number explains an entire political decade, subscribe to Stay Financial Historian. Now, once yields blow out, the euro crisis stops being a headline and becomes a machine, and the engine of that machine is the link between governments, banks, and everyday cash. Banks in many Eurozone countries held large amounts of their own government's bonds, and governments were expected to rescue their own banks if those banks failed. So when investors doubted the government, they doubted the banks. When they doubted the banks, depositors moved money. And once deposits move, credit lines get cut, payments get delayed, and payroll gets missed. That is why an economy can freeze, even when plenty of businesses would be fine under normal financing, because normal financing disappears. Picture that Athens shop owner again, not as symbolism, but as logistics. Your supplier suddenly wants cash upfront, your card terminal starts glitching because banks are rationing liquidity, and customers stop spending because they are scared they will not be able to withdraw tomorrow. That is the doom loop in real life. The euro made it faster because capital flight inside a single currency is frictionless. Moving money from Athens to Frankfurt is not an exchange. It is a transfer. And once leaving the euro becomes thinkable even as a remote possibility, every contract becomes suspect. Because people start asking, will my euros still be euros next year? Now the trap, stated once, cleanly. Before the euro, a country could adjust externally by devaluing its currency. That could restore competitiveness quickly by making wages and prices cheaper in foreign terms. After the euro, members cannot devalue against each other because they share the currency. And they cannot rely on a national central bank to fully backstop their own government bond market, because monetary power is centralized at the European Central Bank. So when the periphery needed to regain competitiveness or stabilize debt, a lot of the adjustment had to happen internally. Wages and domestic prices had to fall relative to the rest of the Eurozone. Economists call it internal devaluation. Normal people experience it as unemployment and wage pressure that does not let up. Spain is the clearest receipt because the labor numbers were so extreme, they became a national trauma. Unemployment peaked around 26% in 2013, and youth unemployment rose into the mid-50% range that same year. Those numbers are not a debate topic. They are lives paused, careers delayed, families postponed. And this is where rules you did not vote on turns from a feeling into something concrete. When bailout money arrives tied to detailed conditions, tax changes, pension cuts, labor reforms, your parliament can still vote, but voters can feel like the menu is already narrowed. Greece's 2015 referendum is the sharpest example. Voters rejected bailout terms, and days later, under bank closures and cash limits, leaders accepted a new deal anyway. You can argue about what was feasible in that moment, but the political message people heard was unmistakable. In a crisis, your policy room shrinks, and it shrinks fastest for the countries that don't control their own currency backstop. One truly fast balance point, because it matters. Different countries had different vulnerabilities. Greece had governance and fiscal credibility problems. Spain had a housing boom. Italy had long-running stagnation. Ireland had a bank-driven credit bubble, but the shared currency made the panic harder to contain and harder to escape. And that is why leaving the euro was not a clean exit. Leaving is not walking out of a room. It is jumping out of a moving car. The moment exit is credible, depositors rush to withdraw before conversion, banks face runs, capital controls appear, imports spike in price, and borrowers with euro-denominated debts can be crushed when their incomes shift into a weaker new currency. So the South was boxed in. Staying meant grinding internal adjustment under strict terms. Leaving risked instant chaos. That is the trap in one sentence. You can't easily stay, and you can't safely go. Every story like this needs a turning point, and Europe's turning point was when the backstop finally sounded real. In July 2012, ECB President Mario Draghi said the ECB would do whatever it takes to preserve the euro, and shortly after, the ECB laid out a bond-buying backstop that signaled it could step in if markets spiraled. You do not need acronyms to get the meaning. The lender of last resort became credible, and credibility can stop a stampede. Now the aftermath, because calming bond markets is not the same as healing a society. If you lived through this as that shop owner, you did not just lose sales. You lost trust. You cut staff, cut inventory, watched demand evaporate, and then watched politics become a constant fight over who was to blame and who was being punished. You heard bailout on the news, but on the street it often looked like higher taxes, less spending, and customers too scared to spend. You watched your friends' kids leave for Germany, Britain, or anywhere that would hire them. You watched people delay marriages and children because stability felt like a luxury. Even when the headlines said recovery, the economy had lost years of investment and confidence, and those are the slowest things to rebuild. Greece remains the symbol because the crisis turned money into a permission slip. In June 2015, capital controls and ATM limits became the image the world remembers. Modern Europeans lining up to access their own cash. And once money becomes conditional, politics does not stay calm. Elections turn into referendums on dignity. Old parties crack, new parties rise. Trust erodes, not just in one government, but in the idea that the system is fair. Meanwhile, in the core, many voters were told a different truth, that they were being asked to underwrite someone else's mess. In the periphery, many voters felt they were being squeezed to protect creditors and preserve a project designed without enough safeguards. Both narratives had pieces of reality, which is why they were so combustible. Finally, the choice, because the euro crisis did not end with a neat moral, it ended with a fork in the road. Here is the plain American comparison that makes it click. In the United States, if Florida gets hit by a hurricane and its economy takes a temporary hit, nobody debates whether Florida should abandon the dollar. There is a federal government. There are automatic stabilizers that keep money flowing without a new negotiation every time. There is a clearer lender of last resort. America still has regional pain, but the system is built so a shock in one state does not automatically turn into a question about whether the currency area survives. Europe built the shared currency faster than it built the shared shock absorbers, and the South paid the price when the storm hit. Europe has adapted since then. New tools, stronger backstops, tighter banking supervision. But the foundational choice is still on the table, and it shapes what the next crisis will look like. Should the Eurozone move toward deeper fiscal and banking integration so the currency behaves more like a true union in a downturn, or should it create a clearer, lawful exit path so membership is not a one-way door when conditions become unbearable? Put your answer in the comments, and tell me what trade-off you are willing to accept, because there is not a painless option. If you know someone who still thinks this crisis was simply countries spending too much, share this with them, because the mechanism is the story. Here is the tight three-part takeaway. Mechanism: one currency without a complete fiscal and banking backstop shifts adjustment onto wages and jobs when shocks hit. Because exchange rates cannot move and national central banks cannot fully catch a sovereign panic. Incentives: when currency risk seems to vanish and interest rates converge, credit can surge, risks can be mispriced, and imbalances can build quietly until one moment exposes them. Lesson: if a system removes escape hatches, it has to replace them with stabilizers that are credible, fast, and automatic, or every downturn turns into a political trial where ordinary people absorb the shock. And the last question to sit with is the simplest test of stable money I know: In the next crisis, will your currency feel like a tool you own, or a rule you are subject to? In the next episode, we will go week by week through how bond markets and emergency lending forced political decisions overnight. Because once you see that timeline, you will understand why European leaders started treating interest rates like a national security threat.